Hi everyone, welcome to this new video. This is about chapter 12, the design of the tax system. This is basically the quick check multiple choice. Remember, this is a book of Gregory Mankiw. The book is called Principles of Economics 7th edition. So our first question says, the two largest sources of tax revenue for the United States federal government are. So we have four options. First, individual and corporate income taxes. Second, B. Individual income taxes and payroll taxes for social insurance. C. Taxes and social insurance. And the last one, payroll taxes for social insurance and property tax. In order to answer in a proper way these questions, we need to verify what information says about the tax revenue of the United States federal government. So remember, during our chapter, we had this table. Basically, in this table, it represents here, let's have a look here, it represents here the tax revenue of the government in three columns. Basically, the amount in billions, remember millions, there are 9 zeros, and here is divided by the amount of people in the United States. So it's going to be around $3,446 per person that they need. Is going to be the tax revenue. This is regarding individual income taxes, and the other one, social insurance taxes. So these two amounts, they represent around 43% plus 36%, so it's going to be 79%, which is going to be represented in these two facts, in individual income taxes and social insurance taxes. So for this reason, we are going to refer our answer in individual income taxes and payroll taxes for social insurance, which is the answer B. The second question says, Andy gives piano lessons. He has an opportunity cost of 50 per lesson and charges 60. So it means, remember, the opportunity cost, it is like the border. It means that, for example, if the lessons of piano, you need to charge 40, and this time Andy won't give any piano lesson. On the other side, we have, this is kind of the supply. On the other side, we have the demand, naturally, and we have two students. We have Bob, and actually Bob has a willingness to pay of $70. So this is going to be like the maximum that this person will pay. If the piano lesson is larger than 70, this person basically won't pay any piano lessons. Or the other student, the other part of the demand, the individual demand, is Carl. Carl has a willingness to pay of $90. Naturally, he has a willingness to pay larger than Bob. So, and we have the next situation. Imagine that the government puts a $20 tax on piano lessons, and Andy raises his price to $80. So we need to verify which is the deadweight loss and the tax revenue. Remember, the deadweight loss is like the comparison when we had the situation of the total well-being before the tax and then the situation after tax. This difference we will consider as the deadweight loss. And the tax revenue is going to be basically the income that the government will receive due to the tax that they are putting or they are charging in the market. So we need to analyze this in different ways. First, we're going to summarize all the information. So we have Andy, opportunity cost 50 and price 60. We have Bob, willing to pay 70, and Carl, willingness to pay 90. And we have the tax of 20. So let's have a look before the tax. So what's going on before the tax? So before tax, we have the Andy's excellent. And remember, Andy's excellent, remember we are here in the surplus of the producer. So basically we have the price that he's charging minus the opportunity cost. So they have a price of 60 and he has an opportunity cost of $50. So it turns out an Andy's accident of $10. So this is kind of a benefit for the producer in this at this time. We have the other part, which is the Bob's accident. The Bob's accident is going to be kind of a safe because he has a willing to pay higher than the price of the market. So this difference, it represents basically kind of a safe, kind of a saving. So in this case, we have the willingness to pay of 70 and the real price of the market, which is going to be charged by our teacher Andy, and we will have a Bob's accident of $10. Then we move on the next individual demand. So we're talking about Carl's accident. It's going to be exactly the same as Bob, just that this time the Carl's accident is going to be $90. So at the end, we will turn out on Carl's accident $30. So at the end, the total well-being of this economy is going to be three facts. First, it's going to be two parts. First, the surplus of producer, then again the consumer surplus, which is going to be divided on the two individual demands. So it's going to be Bob's and Carl's. So in this case, we have Andy's accident plus Bob's accident plus Carl's accident. As a total, we have the total well-being is going to be 10 plus 10 plus 30. It's going to be 50, the total well-being of this economy before tax. And we're going to verify what happened with the tax in the market. So with the tax in the market, so remember we have before tax, this is the total well-being before tax, and after tax. We will have Andy's accident, so the producer part, which is going to be the price minus the opportunity cost minus tax. And then in this time we have the price. Remember, now the price is higher due to the tax, so it's going to be $80. The opportunity cost is going to be the same, it's going to be 50, and 20 naturally is going to be taken by in this time by the government. So it's going to be this 20. So we need to subtract here. So at the end, we will have Andy's accident is going to be 10. And then Bob's accident, remember the willingness to pay 70, and the price now in the market is 80. Naturally, the Bob's accident is minus 10. It doesn't make any sense. It's going to hurt you this kind of decision because the willingness to pay is lower than the price of the market. Naturally, you won't pay for that service, for that good, in this case, the service of the piano lesson. So Bob, at this price, unfortunately, they won't move. They won't consume any piano lesson. On the other side, we have the Carl's accident. With this case, we have the willingness to pay minus the price. It's going to be 90 minus 80. It's going to be 10. So at the end, the total well-being is going to be represented by four parts. Andy's accident, which is going to be 10. Bob's accident, which is going to be 0. Carl's accident, which is going to be 10. And the government income. Okay, so in this case is going to be 40. So at this time we can represent here the total well-being before tax naturally is higher than after tax, And here we have the deadweight loss, which is going to be the difference between the two situations, and as a result we have the deadweight loss of time. And the tax revenue is going to be 20 for just one lesson. And at this time, so we have here that the more accurate answer, according to me, is going to be A, 10 of deadweight loss, and tax revenue is going to be 20. The third question says, if the tax code exempts the first 20,000 of income from taxation and then taxes 25% of all income above that level, then a person who earns 50,000 has an average tax rate of percent and a marginal tax rate of percent. So here we are. Remember, when we have until $20,000 as income, it's going to be no taxes. When we move on, the 20,000 higher is going to be 25%. So if we have 50,000 of income, so $50,000, then we know that this first 20, there's not going to be any charge at all. Then after this 30, this is going to be charged at a rate of 25%, which is going to be $7,500. Then we can conclude that the average tax rate is going to be 7,500 over this 50,000. So this one is going to be the average tax rate of all these 50,000. When we understand as a marginal tax rate, we are taking into account the value that overcome, or let's say superate this this 20, so it's going to be just this 30. So at the end, this is going to be the marginal rate after you surpass this $20,000. It's going to be 25%, and the answer will be this time A, 1525. The fourth question says, a toll is a tax on those citizens who use toll roads. This policy can be viewed as an application of. So we have four options as usual: the benefits principle, horizontal equity, vertical equity, tax progressivity. So here we need to remember a little bit about the definitions of those applications of taxes. So the first is the benefits principle. So it says that a person who gets great benefit from a public good should pay more than a person who gets little benefit. We have the other one, horizontal equity. It says that taxpayers with similar abilities to pay should contribute the same amount. Vertical equity says that the taxpayers with a greater ability to pay should contribute a larger amount. And then the taxpayers with higher income should pay more. To tell you the truth, these A and C, like, they're kind of familiar, they're very similar, but at this time I should say that it could be better this time, the benefits principle, because at this time just people that they use the toll roads, they should be charged in this time to pay that. So people that naturally they don't use these toll roads, they won't pay. So at this time, the person who gets the great benefits, it means people they go through toll roads, they should pay, and the other ones that they don't use too much, so they don't pay for that. And the last one we have here, the options, is basically the United States taxpayers in the top 1% of the income distribution pay about percent of their income federal taxes. So here we have like the tax rate from, like, divided from the incomes of the people, and we will have a look at people that they have this kind of higher, this kind of higher incomes, they pay more than 20%. So naturally it should be this D, 30% of the total income. So basically that's all for today. I hope it's worth, and see you the next video. Bye bye.